You want to know what's wild about this market right now? Half the financial world is fixated on one ticker, one launch, one name that's been dominating every podcast, every Twitter feed, every dinner table conversation about money. And while everyone's looking up at the rocket, they're missing two opportunities sitting right in front of them, quietly, without the headlines. I've spent weeks digging through the numbers on this, and what I found genuinely surprised me. There are two companies right now trading at prices that make far more sense than the IPO grabbing all the attention. And if you stick with me until about the 10-minute mark, I'm going to walk you through a specific income strategy that lets you get paid while you wait to buy these stocks at the price you actually want. It's the kind of thing most retail investors never even consider, and it changed how I approach entering any position. Quick favor before we get started, if you're serious about building real wealth and not just chasing whatever's trending this week, hit that subscribe button. This is Stock Pulse Alpha, and we're building a community of investors who think for themselves. Let's get into it. The IPO everyone's talking about. Let's address the elephant in the room. SpaceX is going public, and the entire investing world has lost its mind over it. And look, I understand why. What Elon and that team have built is genuinely historic. Reusable rockets, Starlink covering the planet, crewed missions to the ISS. This is not a company you mock or dismiss. Goldman Sachs is projecting their AI-related revenue could grow from around $3.2 billion in 2025 to roughly $322 billion by 2030. That's a 100-fold increase in 5 years. Staggering. But here's where I need you to slow down with me. The price you pay matters as much as the quality of the asset. And SpaceX is reportedly coming to market at around $135 per share, implying a valuation near $1.77 trillion. That would instantly make it one of the most valuable companies on Earth, before it has produced consistent profits. The company reportedly lost billions last year. At that IPO price, you're paying close to 95 times revenue. Not earnings, revenue. And here's where it gets uncomfortable. A lot of people are openly assuming this thing doubles on day one. If that happens, you're looking at a $3.5 trillion valuation, nearly 190 times last year's revenue. You'd be betting that a company with massive ongoing losses grows into one of the largest valuations in human financial history, starting from day one. That's not investing, that's speculating. And there's a real difference between those two things, where the real opportunity lives. So if SpaceX is priced for perfection, where should serious money actually go? It goes to companies with proven revenue, expanding margins, real cash, and competitive moats that aren't disappearing anytime soon. When I run that filter, two names keep rising to the top. Palantir Technologies, PLTR, and NVIDIA, NVDA. Let me show you why. Palantir, PLTR, Palantir. The same Palantir that's been on a tear for 2 years? Yes, exactly that one. Especially right now. The stock has pulled back roughly 13% over the past week, trading around $135 after some investors bought in the 150 to 160 range. For a lot of people, that drop feels like a warning sign. To me, it's the opposite. A pullback in a fundamentally strong growth company isn't danger, it's discount. Here's why I'm paying close attention. Balance sheet. Roughly $8 billion in cash with minimal debt. In a higher rate environment, that's a fortress. Palantir isn't hostage to credit markets, and that flexibility compounds over time. Revenue growth, top line growing at 85% year over year. US commercial segment up 133%. Full year guide raised by 71%, which is unusually aggressive for a software company at this scale. Margins expanding from around 31.6% to 37% on a trailing 12-month basis. They're not just growing, they're growing more profitably as they scale. Embedded moat. Their software runs sensitive government intelligence workloads and mission-critical commercial analytics. You don't rip those systems out, the switching costs are enormous. Now, here's the part one know somebody is going to bring up in the comments. The PE ratio. Yes, Palantir trades around 150 times earnings. That makes some investors uncomfortable. Fair. But a year ago, that PE was sitting near 600. It's coming down fast as earnings grow into the price. That trajectory matters. The company is growing into its valuation. That's the opposite of what you're being asked to do with the IPO everyone's chasing, where you have to bet on flawless execution 5 years out just to justify today's price. A quick pause if this kind of analysis is useful to you. Take 5 seconds and hit the like button. It genuinely helps this content reach more investors who want to think carefully instead of chase headlines. NVIDIA, NVDA. If Palantir is the underappreciated analytical play, NVIDIA is the heavyweight champion of the AI infrastructure build-out. And yet, here's what's fascinating right now. NVIDIA reported earnings recently, the numbers were strong by any reasonable measure, and the stock sold off on the news. This is a pattern that has played out over and over again with this company. Every single time long-term holders or buyers on the dip have been rewarded. Stop thinking of NVIDIA as a chip company. That mental model is outdated. NVIDIA is the foundational infrastructure layer of the entire global AI build-out. The GPUs, the CUDA software ecosystem, the data center platforms. They're selling to hyperscalers, sovereign governments, enterprises across every industry, and a whole generation of AI startups that didn't exist 3 years ago. The demand is structural, not cyclical. The world isn't going to wake up next quarter and decide it needs less compute. The stock is trading around $210 as I record this. Not cheap on traditional metrics, but the growth rates justify a premium in a way that's grounded in actual revenue and actual margins, not aspirational projections about what the company might be in 2030. The strategy most retail investors never use. Here's the part of the video I really want you to sit with, because this is where serious investors separate themselves from the crowd. I want to talk about selling put options as a way to enter both of these positions. I know options can sound intimidating. Let me break it down as simply as I can. When you sell a put, you're agreeing to buy a stock at a specific price, the strike, by a specific date. In exchange, the market pays you cash up front. That premium hits your account the moment the trade fills. You keep it no matter what happens next. Let me show you what this looks like in practice. Palantir example, say PLTR is at $135, and you'd really prefer to own it at $130. Instead of waiting and hoping it drops, you sell a $130 put expiring in about a month. The market might pay you somewhere around $5 to $5.80 per share for that contract. Each contract is 100 shares. So we're talking $500 to $580 in cash today for one contract. Then one of two things happens. PLTR stays above $130 at expiration. The put expires worthless, you keep the entire premium, pure profit. No shares purchased, run the strategy again next month. PLTR drops below $130. You get assigned 100 shares of a company you wanted to own anyway. Your effective cost basis is around $124 to $125 after subtracting the premium. You bought a quality stock meaningfully below market. NVIDIA example, same logic, different numbers. With NVIDIA near $210, a $200 strike put around 30 delta with about 30 days to expiration is currently generating roughly $600 or more per contract. Implied volatility is a bit lower than Palantir at around 40%, but the absolute premium is still attractive given the share price, and the liquidity is incredible. Tens of thousands of open interest on popular strikes, tight bid-ask spreads, you're not bleeding money on every fill. Quick question for you. Drop a comment below and tell me, have you sold puts before, or is this completely new to you? Knowing where you're starting from helps me make better content for this community. The rules I follow, a few things that took me a while to learn the hard way: target the 30 delta, roughly a 30% chance the option finishes in the money, roughly a 70% chance you just collect and walk away, good odds over time. Stick to monthly expirations. Weekly and non-standard expirations often have wide spreads and zero liquidity. You'll get bad fills, don't fight it. Only sell puts on stocks you actually want to own. This is the whole game. If you don't want assignment, don't sell the put, period. Higher volatility means higher premiums. Palantir's around 49% is paying you well. Volatile periods in quality names become opportunities, not threats. And managing the trade once you're in it is honestly simple if you're using this to enter long-term positions. Option expires worthless? Great. Collect and repeat next month. Get assigned? Great. You now own a quality company at a discount. You're being paid to be patient. The only reason I'd close a position early is if something fundamental changes with the company, or if the put moves so far against me that I no longer want the shares at that strike. Otherwise, I let it run. Bringing it all together, if I had to rank these for you right now, NVIDIA first for the structural AI demand and the unmatched liquidity, Palantir second for the asymmetric growth potential and the recent pullback creating a better entry, and the IPO everyone's chasing, not on my list at this valuation, maybe at $800 billion, not at nearly $2 trillion before profitability. Here's the bigger picture. When you're managing real money that took real time and real effort to build, the question isn't whether a company is great, it's whether the price gives you a margin of safety. SpaceX at this valuation doesn't. NVIDIA and Palantir do. And if you layer in a disciplined put-selling strategy on top of that, you're generating income, lowering your cost basis, and putting time on your side instead of against you. Hope is not a strategy. Process is. This is my analysis based on the research I've done. Your situation is different from mine. Always do your own homework before putting capital to work. Before you go, 3 quick things. Smash that like button if this gave you a clearer way to think about the markets right now. Subscribe and hit the bell so you don't miss the next breakdown. Drop a comment telling me which of these 2 stocks you'd rather own and whether you'd sell puts to enter or just buy shares outright. I read every comment. Next week, we're going deeper into a sector that's been quietly setting up for one of the most interesting setups I've seen in a while. You don't want to miss it. I appreciate you spending your time here. See you in the next one.